Hey everyone, if you earn money outside of a regular paycheck, even a small amount, this message is important for you. Because right now, the IRS is paying closer attention to side income than most people realize. And a lot of people are getting caught off guard, not because they did anything illegal, but because they didn't understand how the system works. I want to be very clear from the start. This is not about scaring you. This is about making sure you don't accidentally trigger an IRS notice that could have been avoided with the right information. Everything I'm about to explain comes from real situations I've seen over and over again. This is not theory. This is how the IRS actually looks at side income today. So first, let's slow this down and talk in plain English. When people hear the term side hustle, they often think it only applies to full-time gig workers or people making serious money online. That's not how the IRS sees it. Side income is any money you earn outside of a traditional W-2 job. That includes driving for rideshare apps, delivery work, selling items online, freelance services, content income, cash jobs, payments through apps. If you provided a product or a service and received money in return, that income exists in the IRS's eyes, even if it was part-time, seasonal, or something you only did a few times. And here's where a lot of people get confused. They assume the IRS only cares about large amounts. They assume small side income flies under the radar. They assume if nothing happened last year, nothing will happen this year. That assumption is where problems begin. The reason the IRS is focusing more on side income right now is simple. They can see it more easily than ever before. Platforms track transactions, marketplaces track sales, payment processors generate records, banks track deposits. And the IRS uses automated systems to compare what you report on your tax return with what third parties report about you. This comparison is the most important thing for you to understand. The IRS doesn't start by asking questions, they start by matching numbers. If your tax return says one thing and a platform or payer reports something different, a computer notices that mismatch automatically. There doesn't need to be a human reviewing your return. There doesn't need to be a large dollar amount. There doesn't need to be intent. A mismatch alone is enough to trigger attention. And this leads to the most common mistake people make. They believe the amount they earned was too small to matter. Let me explain why that thinking is dangerous. If you earned side income and didn't report it and nothing happened, that does not mean the IRS didn't care. It usually means the IRS didn't see it. But when the IRS does see income, the size does not protect you. For example, imagine you earned a little over $2,000 from a side project. That platform sends a tax form reporting that amount, but your tax return shows zero side income. From the IRS's perspective, that mismatch is clean and obvious. They don't know your expenses. They don't know your profit. They only see income that appears unreported, and that's how IRS letters begin. Now here's where it gets worse. Even if you had expenses that wiped out most or all of that income, the IRS doesn't automatically know that. If the income wasn't reported properly, they will assume the full amount is taxable until you prove otherwise. That means a small mistake can turn into a much bigger headache later. This is why reporting correctly matters, even when your profit is small or zero. Another mistake that causes serious trouble is waiting for tax forms and assuming that no form means no income. That is not how tax reporting works. You are required to report income whether or not you receive a tax form. If a form gets delayed, if it gets lost, if you didn't download it, if you forgot about it, none of those excuses matter to the IRS. From their point of view, it is your responsibility to know what you earned and report it accurately. I've seen many people say, "I never got the form, so I didn't think it counted." That explanation does not protect you. The IRS assumes you knew or should have known about the income. Now let's talk about cash and payment apps, because this is another area where people feel falsely safe. Cash income is harder for the IRS to track up front, that's true. But most people don't keep cash completely isolated. They deposit it, they transfer it, they pay bills with it, they move it through apps, and once that happens, patterns begin to form. If someone deposits cash regularly, if payments appear consistently, if transfers don't match reported income, those patterns raise questions. If an audit ever happens and you can't explain where that money came from with records, the situation becomes very difficult very quickly. This is why organisation matters more than people think. One more major issue that creates chaos is mixing personal money with side income. When everything runs through one personal account, transactions blend together. It becomes hard to separate business expenses from personal spending. And when records are unclear, mistakes happen. People either forget legitimate deductions and overpay taxes, or they guess and underpay, which creates risk. The fix is simple but powerful. Separate your side income activity from your personal finances. Even a basic second account or dedicated card makes a huge difference. Now, before moving forward, there's something you need to understand clearly. The IRS does not manually review most returns. This system is automated. Software looks for mismatches. Software looks for unusual patterns. Software flags odd activity. That's why IRS letters can go out at such a large scale. It's not personal, it's not targeted, it's mechanical. And once that process starts, it takes time, stress, and sometimes money to resolve. So the goal is not to panic. The goal is to avoid being flagged in the first place. Now let's talk about what actually triggers IRS attention, because this is where most people misunderstand how the system works. The IRS does not sit there reviewing individual tax returns one by one, looking for small side hustles. That's not how this operates. What happens instead is far more mechanical. The IRS uses automated systems that look for inconsistencies. These systems compare multiple data points: what you reported, what others reported about you, what your banking activity looks like, what your patterns looked like in prior years. When something doesn't line up, the system flags it. One of the most common triggers is third-party reporting that doesn't match your return. If a platform reports income under your name and your tax return doesn't reflect it, that's a clean mismatch. It doesn't matter if the amount is small. It doesn't matter if you meant to fix it later. The system only sees numbers that don't match. Another trigger is deposits that don't make sense based on your reported income. If your return shows very low income, but your bank activity shows regular deposits, the system notices that pattern. It doesn't immediately accuse you of wrongdoing, but it does raise questions. Large expenses with very little income can also attract attention. If your side activity shows heavy deductions year after year, but almost no revenue, the system may flag that pattern as well. Again, not because expenses are illegal, but because unusual patterns stand out. Sudden swings are another issue. If one year you report significant side income and the next year it disappears entirely, the system takes note. Big changes aren't automatically wrong, but they are something the IRS may want explained. And when multiple platforms report activity, but your return shows very little or nothing, that inconsistency becomes more obvious. All of this happens without human involvement at first. That's why IRS notices can feel sudden and confusing. It's not personal, it's not emotional, it's procedural. Once a notice is triggered, the burden shifts to you to explain and prove what happened, and that's where people feel overwhelmed. This is also where a lot of myths cause damage, so let's clear a few of them up clearly. One myth is that money received through apps isn't real income. That's false. The method of payment does not change the nature of income. Cash, check, app, transfer, income is income. Another myth is that no tax form means no reporting requirement. That's also false. Tax forms are reporting tools, not permission slips. Your obligation to report income exists whether a form arrives or not. Another myth is that if you're not a registered business or an LLC, it doesn't count. That's not true either. From the IRS's perspective, if you earned income, you are operating as a sole proprietor by default. Formal business registration is not what determines taxability. And another common misconception is that hobby income can be ignored. While hobbies are treated differently, in some ways, the income itself still exists. The IRS does not ignore income simply because it came from something you enjoy doing. Now let's walk through a real-world example so you can see why this matters. Imagine you earn $6,000 from a side activity over the year. That income is reported by a platform. Now imagine you had legitimate expenses, supplies, fees, tools, costs, totaling $4,000. In reality, your true profit is $2,000. That's the amount you should be taxed on. If you report this correctly, you pay taxes on the $2,000. The situation is clean. The math makes sense. There is nothing unusual for the IRS to question. But if you don't report the income at all, the IRS only sees $6,000. They don't see your expenses yet. They don't see your profit calculation. They see unreported income. So they estimate taxes based on the full amount. That could mean a tax bill that's far higher than what you actually owe. And now, instead of calmly reporting income once, you're dealing with notices, explanations, documentation requests, and months of uncertainty. You may even need professional help to resolve it. All of that stress came from something that could have been handled cleanly up front. This is why proper reporting protects you, even when income feels small. The goal is not perfection. The goal is clarity. So what's the safest approach if you have side income? First, track your income independently. Do not rely entirely on year-end forms. Those forms confirm information. They should not be your only record. A simple spreadsheet is enough. Dates, amounts, source. Second, separate side income from personal money. This doesn't need to be complicated. A separate account or card is enough to create clarity. When everything is mixed together, mistakes happen. Third, keep basic records, invoices, receipts, platform summaries. You don't need elaborate accounting software to stay organized. You just need consistency. Fourth, don't guess expenses. If an expense is real, document it. If you're unsure, research it or leave it out. Guessing creates risk. And finally, set aside money for taxes as you go. This removes stress later and gives you control. This approach is not about fear. It's about staying ahead of the system instead of reacting to it. The people who struggle the most are usually not hiding income. They're disorganized. They wait until the last minute. They hope things will sort themselves out. The system does not reward that approach. Side hustles are more common than ever. The IRS knows this, and their systems have adapted to track modern income streams more efficiently. That doesn't mean side income is bad. It means it needs to be handled properly. If you treat it seriously, keep records, and report accurately, there is very little to fear. If you ignore it, assume it's invisible, or hope it's too small to matter, that's when problems begin. So take control now, stay organized, report clearly, and don't wait until April to think about it. If this helped you understand how side income is really treated, I appreciate you being here. Subscribe for clear, practical explanations like this, and take care.